Welcome to the deep dive. Today, we're tackling a financial challenge that honestly feels deeply unfair to a lot of people.
Hmm.
It's this idea of building a credit history from scratch when you're in a completely new system.
Yeah, and it hits so many people. We're talking non-residents trying to get a foothold in the U.S., or even just someone who's been, credit invisible for
The
years.
barrier to entry is just immense.
It's a really painful reality. We've looked through sources that tell these stories of like highly successful professionals,
Right.
people who arrive in the U.S. with absolutely flawless financial histories back home. They can 800 plus score in Canada or the UK, and then they get here and poof,
Nothing.
they're effectively unrated.
Yeah.
You start with absolutely zero leverage, and that just translates into a massive financial headache.
And that headache, it affects everything. So our mission today is to give you a tactical blueprint.
Yeah.
We want to unpack the exact products, the timelines, the specialized services that can turn that blank slate into a strong credit foundation and do it quickly.
Which is so critical.
Because here in the U.S., a strong personal credit score isn't just about getting a low-interest loan. It's the gatekeeper.
Mm-hmm.
For apartment leases, for business financing, decent insurance rates, even some job clearances.
And that last point, the business financing one, that's the critical difference we really need to underline.
How so?
Well, in a lot of other global financial centers, your business credit is sort of a separate entity from your personal finances.
Right.
Not so much here. If your business is new, or if you're trying to get that first high-limit business credit card, the banks, they're going to put significant weight on your personal credit history.
So no personal score, no business credit.
Pretty much. If you don't have a personal score, or if it's below 700, your business options are severely limited. Our goal today is to get you past that initial, really restrictive, unscorable phase.
And to do it within, 12 to 24 months?
That's the goal.
Okay, so let's unpack that frustrating reality first, this whole cross-border credit conundrum.
Mm-hmm.
You mentioned that person with an 800 score who suddenly has nothing. It just feels completely counterintuitive, doesn't it? That a documented history of financial responsibility just vanishes when you cross a border.
It does feel archaic, but that's the core rule. Credit history doesn't transfer because it's tied to a domestic identifier.
The Social Security number.
Exactly, the SSN. So since newcomers often don't have that yet, or their file is brand new, lenders they can't assess the risk.
And that throws up immediate barrier.
Immediate. The sources we looked at repeatedly note the frustration of paying these massive, like 4-figure security deposits just to turn on the electricity or get a cell phone plan.
So are there any real exceptions, any workarounds that can give you a true initial lifeline?
Yes, there are a few limited workarounds, but you have to be positioned correctly to use them.
Right.
The first place to look is banks with really robust cross-border operations. So we're talking about institutions like HSBC, TD Bank, maybe RBC.
Because they operate globally.
Right. Because they have these global underwriting standards and share some asset verification tools, they can sometimes leverage your existing non-U.S. credit history or assets to issue a U.S. product.
Like a credit card or something.
Exactly, a low-limit credit card, or maybe even pre-approve a mortgage, especially if you hold substantial wealth with them.
That sounds like a massive tactical advantage if you're moving assets. But let me challenge that for a second.
Go ahead.
The sources suggest these programs often require, significant pre-existing relationships or pretty high minimum asset levels to activate.
That's a fair point.
So if you're a newcomer starting with little liquid capital, isn't this option effectively off the table?
You're absolutely right. It's more of a solution for the high net worth traveler, not necessarily for the average person arriving to start a new job.
Okay.
So for that group, the second set of workarounds becomes much more relevant: specialized services. Look at a company like Nova Credit, which developed something called a credit passport.
The credit passport, what's that?
Their service basically translates international credit reports, and they cover like 2.8 billion individuals across more than 20 countries
Wow.
into a standardized, local equivalent credit score and related metrics.
That's fascinating. So it's essentially giving the U.S. lender a language that they can understand so they can assess the risk on an international arrival.
Precisely. It just cuts through that whole blank file problem. It's especially useful for things like rental applications, securing that first apartment.
Any others?
Yeah. We also saw an exception for American Express.
Ah, Amex.
Having an Amex card in one country sometimes opens a path for easier approval for a U.S. card through their global transfer program. But even here, it is not guaranteed.
Why not?
The U.S. entity is legally distinct. Sources confirm that even a 20-year positive Amex history abroad might only get you a really low initial limit here.
Okay, so if those high leverage workarounds aren't an option, or if the initial credit limit is just too low, you're forced onto the fundamental track.
The fundamental track.
And for non-residents, or those still waiting for their SSN, that means building credit using the Individual Taxpayer Identification Number, the ITN.
The ITN track is the proven foundation, the personal credit you build here, that serves as the eventual springboard for much higher business credit lines.
Okay.
So to get the kind of scores you need for, say, a $10,000 unsecured business card, you have to execute a very precise multi-step plan.
Lay out those steps for us, starting with the logistics.
Okay, first you have to secure that ITIN through the IRS. It's for tax reporting, but it's also widely accepted by a lot of financial institutions for credit applications.
Step 1.
Step 2, you have to establish residency and open a U.S. bank account. You just need that transactional history. And then third, and this is the heavy lift, you need to acquire 4 to 5 secured credit cards.
Whoa, 4 to 5. That seems like an excessive number of applications, especially when you're already resource constrained. Why so many? Why not just 1 or 2? It's purely strategic, and it really speeds up the clock. Lenders assess risk based on several factors, including the depth of your file.
The depth.
Yeah. So having 4 or 5 secured cards, each one requiring a refundable deposit that acts as your limit, it does several things at once.
Okay.
It gives you multiple lines of credit, all reporting positively. It increases your total available credit, which is crucial for managing your utilization. And it just provides a diverse set of trade lines early on.
So it's not just about paying one bill on time. It's proving you can juggle several accounts responsibly all at once.
Exactly. And the non-negotiable step 4 is responsible use. You have to make sure all these cards report to all 3 major bureaus, Equifax, Experian, and TransUnion.
All 3?
All 3. Use them for small, everyday purchases, pay the full balance, not just a minimum on time, every single month, and keep your credit utilization ratio below 30%. Ideally, you want to shoot for 10 to 20%.
Let's talk about the payoff timeline for all this consistent effort.
Yep.
When do you actually see a score that matters? Well, the timeline is tied directly to consistency. In the first, say, 3 to 6 months, you'll likely see your first score form.
Okay.
It might be low, maybe in the mid-600s, but the file is now visible. Then, by 6 to 12 months of flawlessly executed payments on those 4 or 5 cards, you should be visible to all the major lenders and aiming for a score of 670 or higher.
And what's the practical difference between a 650 score at 6 months and, say, a 680 at 12 months?
Oh, the real-world difference is huge.
Yeah.
At 6 months, you might be able to qualify for an unsecured card with a very low limit, maybe get a small security deposit back from one of your cards. But at the 12-month mark, when you cross that 600 threshold,
That's the key.
that's when you can expect lower insurance premiums, far better apartment rental acceptance rates without needing a cosigner, and you'll start getting pre-approvals for entry-level unsecured cards.
And to get to that level of financial flexibility we talked about, access to serious business financing, what's the timeline and score we're aiming for there?
That takes a bit more patience and consistency. You're really aiming for the 12 to 24-month mark. Continued responsible use should push you over 700.
That 700-plus score is the real gatekeeper.
It's the true gatekeeper. It lets you transition completely away from secured products, qualify for the best travel reward cards, and, most importantly for entrepreneurs, get access to those high-limit business credit cards and favorable lines of credit.
Okay, let's talk about a specific tool that's designed to accelerate this process, especially for people who are still classified as credit invisible.
Right.
Those with either no credit report or, fewer than 3 active credit lines. We're talking about the Credit Builder Loan, or CBL.
The CBL is an ingenious product. It's really clever because it addresses that core systemic problem. How do you get a loan if you don't have a credit history?
Right, the chicken and the egg problem.
Exactly. Its mechanism is unique. A credit builder loan is a small dollar consumer installment loan, typically ranging from, say, $300 up to $1,000, usually with terms of 12 to 24 months.
Walk us through the mechanics. If it's a loan, where does the money go?
Okay, so here is the key mechanism. The loan is secured by the loan proceeds themselves.
Okay.
So when the lender approves you for, let's say, $500, those funds are immediately deposited into a restricted interest-bearing savings account or a certificate of deposit. You don't touch them.
So you take out a loan, but the bank just holds the money.
Exactly. You then make monthly, on-time payments against that $500 principal plus interest for the next 12 months. Each payment gets reported to the credit bureaus.
Ah,
And only after you've made all the payments is that $500 principal plus any interest it earned released to you. It's a genius dual benefit.
you build credit history and you accumulate mandatory savings.
That's it.
But wait, if I can't access the money for a year, what's the cost of this service? I mean, what kind of interest rates or fees are we looking at for a loan where the funds are immediately locked up?
That's a crucial perspective. CBLs are definitely not cheap credit.
I'd imagine not.
Because the lender is taking a risk on someone with zero history, the interest rates can sometimes be quite high. We're talking anywhere from 8% up to 15, even 18%.
Wow.
So you might end up paying, $50 or $70 in interest over the course of the loan to borrow $500. But you have to remember, you're paying that fee for the reporting mechanism,
Not for the liquidity.
not for the liquidity. You're paying for the credit establishment.
That reframes the cost. It's an investment in your score, not a cheap way to borrow money. So what kind of returns do we see on this investment?
For the credit invisible segment, the returns are phenomenal.
Really?
Yeah, sources show that unscored borrowers who successfully pay off a CBL often establish an average score between 643 and 680.
That's a huge jump from nothing.
It is. And individuals starting below 520, which is basically a severely damaged file, they saw average score increases of 90 points. It's designed for that massive initial jump.
It sounds perfect for the newcomer, but I imagine it's not for everyone.
No, it has a very specific target audience.
Yeah.
CBLs are significantly less effective for those who already have strong credit, say, scores above 660.
Why is that?
For those people, adding a small installment loan might actually cause a slight decrease because of the new credit inquiry. It's also not effective if you have serious active delinquencies or massive debt. A $500 loan isn't going to offset years of missed payments.
Right. And we also saw some research that highlights the importance of surrounding this product with the support, that the CBL shouldn't just be a standalone tool.
Absolutely. The research indicated that CBL borrowers who also got financial coaching saw significantly enhanced outcomes.
How much better?
An average score increase of 60 points compared to 47 points without coaching. It just emphasizes that holistic approach. You need the right tools. That's access the right guidance, which is knowledge, and the follow-through, the actions.
It all works together.
Yeah, and we're even seeing specialized program variations now, like LISC's twin accounts, which matches the monthly payment dollar for dollar, or these tiered structures called credit building ladders.
Ladders.
Yeah, where you start small, maybe a $100 loan, and then you graduate to larger amounts like $1,000 once the formula is paid off.
That layered approach makes a lot of sense. Okay, now let's transition to maximizing that score once the foundation is laid. Once those secured cards and CBLs are on the file, we need to talk about the 5 factors that make up your score, specifically the credit mix.
The 5 factors are your North Star for score maintenance. The 2 heavy hitters are payment history, that's 35% of your score, and amounts owed, or utilization, at 30%.
So that's 65% right there.
Yep. Then you have length of credit history at 15%, and the 2 smaller but critical factors. New credit at 10%, and credit mix also at 10%.
And that 10% for credit mix is highly strategic for the person who has just followed the ITIN and secured card path?
Yeah.
What exactly is the mix?
The mix just refers to the blend of different debt types. You want to show that you can responsibly manage both revolving debt, so that's your credit cards, and installment loans.
Like mortgages, car loans.
Or in our case, the credit builder loan. So if you spent the first year using only secured credit cards, which is all revolving debt, adding a paid-off CBL or a small personal loan instantly leverages that 10% credit mix factor.
Giving you a score lift because your profile is now more diversified.
Exactly.
It's a very efficient way to gain points. Another quick win mentioned in the sources, particularly for someone with a thin file, not enough accounts, is becoming an authorized user.
This is a powerful tactic, but you have to use it carefully.
How does it work?
As an authorized user, you're added to someone else's existing, well-aged, high-limit credit card account. And you benefit instantly from 2 major factors. The primary user's positive payment history, and their usually high credit limit.
How does that benefit your utilization so quickly?
Well, if the primary user has, say, a $20,000 credit limit and only uses $1,000 of it, their utilization is just 5%.
Right.
When you get added, the credit bureaus sometimes incorporate that $20,000 limit into your overall credit capacity calculation. So suddenly, your personal utilization ratio just plummets, which gives you an immediate, potentially large boost.
What's the necessary caution here? Because that sounds almost too easy.
The caveat is twofold. First, the primary user is legally on the hook for the debt. But if they miss a payment, that negative mark shows up on your file too. You're tethered to their performance.
That's a big risk.
It is. And second, if you're ever removed from the account, say, a year later, when your own file is strong, that entire positive history in the utilization benefit often just vanish from your report.
So it's a temporary boost.
It should be viewed as a temporary springboard to gain momentum, not a permanent part of your portfolio.
Excellent point. So the ultimate quick wins for our listener today, regardless of their path, monitor those credit reports constantly.
Yeah.
Sources show up to 80% of reports have errors, which you have to dispute. Keep utilization religiously below 30%, ideally 10. And finally, do not close old accounts, even with zero balances.
Right, because closing them damages your length of credit history and shrinks your overall available credit, which artificially spikes your utilization.
At the end of the day, consistency is what lenders are buying.
They just want evidence of dependable repayment over time.
We've covered a ton today, from the essential tactical plan of leveraging secured cards and an ITIN over 12 to 24 months to the highly targeted boost from a credit builder loan.
Yeah.
The takeaway seems clear. Financial citizenship in the U.S. has a price of entry, and that price is consistent, measured effort over about 2 years.
And that leads us to the bigger picture. We focused entirely on the traditional path, cards and loans that report to the 3 major bureaus.
Right.
But what's fascinating now is the acceleration of alternative data. Companies and scoring models like FICO XD and VantageScore are increasingly incorporating non-traditional payments.
What kind of payments?
Things like your utility bills, subscription services, and positive rental payment history. They're using all of that to generate initial scores for people with thin files.
That fundamentally changes how people can prove their financial stability.
It does. And this raises a really important question for you, the listener, to consider as you continue to build your foundation.
Which is?
As technology evolves and the use of rent and utility payment history becomes more prevalent, will a strong history of paying these services eventually outweigh the need for traditional credit products? Or will the credit card and loan path always remain the most powerful and necessary way to signal robust financial stability to sophisticated, high-limit lenders? That's a market shift worth watching very closely.